Welcome back. Today, we are focusing on one of the most important investments you will ever make: securing your child's future. In this video, we will walk through a complete, step-by-step guide to building a bulletproof education fund using a straightforward yet powerful financial tool, the Deposito. Let's dive in. Why should you choose a Deposito for your education funds? There are three main reasons. First, capital preservation. There is absolutely zero risk of losing your principal amount because it is backed and guaranteed by the LPS, or deposit insurance. Second, forced discipline. By locking your funds for a specific tenor, whether that is 1, 3, 6, or 12 months, you effectively prevent any impulse spending. Finally, predictable growth. Because the interest rates are fixed, you can calculate exactly how much money you will have on hand when the school year starts. Let's get into the procedure, starting with the setup phase. Step 1. Calculate the target. You need to determine the exact admission fees and map out your timeline. For example, projecting that you will need $5,000 in exactly 3 years. Step 2. Choose the right bank. Don't just settle. Carefully compare the interest rates between traditional banks and digital banks. Pro tip: digital banks often offer significantly higher yields, which can help you reach your target much faster. Next, we move to execution and management. Step 3. Open the account and allocate your initial lump sum directly into the time deposit. Step 4 is the most crucial part of this system. Set your deposit to automatic rollover, or ARO. You must ensure that both your principal amount and the interest you earn are automatically reinvested. This is the exact mechanism that triggers compound growth. If you want to optimize your liquidity, you need to use an advanced strategy called Deposito laddering. This involves dividing your total education fund into multiple deposits with completely different maturity dates, based exactly on when your child will actually need the funds. For instance, Ladder 1 matures in 1 year to cover next year's tuition. Ladder 2 matures in 3 years to perfectly align with junior high admission. And Ladder 3 matures in 6 years to cover high school admission. You get the growth, but you also have the cash right when the bills arrive. The golden rule of education funding is simple: start early, stress less. When dealing with compound interest, time is your absolute biggest asset. Start building that foundation today. If you found this framework valuable, please like, comment, and subscribe for part 2. See you in the next video.